Hey there. It's interesting to observe how Singapore's high-yield stocks are gaining significant attention, especially considering the struggles faced by most Asian markets amidst the recent tariff wars, where Singapore's defensive stocks are surprisingly thriving. Contrary to the common investor sentiment of avoiding Asian markets during trade tensions, Singapore's defensive sectors are not just surviving but demonstrably outperforming their regional counterparts, with the key being an understanding of the specific sectors that benefit during periods of economic uncertainty. Having tracked Singapore's market response to global trade tensions for years, a clear pattern emerges where telecom, utilities, and industrial stocks consistently offer shelter during turbulent market conditions. And today, we'll delve into which specific Singapore stocks are currently attracting smart money and explore why they might warrant a place in your investment portfolio. Hey friends, welcome back to the channel. I'm Iggy from the Investing Iguana, where I cover topics ranging from stocks and finance to CPF and everything related to growing your wealth. Ranked 8th in the 2024 Influential Tigers by Tiger Brokers with over 850,000 reads and 53,000 likes, and having produced over 800 videos with more than 350,000 watch hours as of February 2025, my focus also extends to regional and global economic trends. Let's begin with a surprising trend. Institutional investors are shifting their focus away from Singapore's traditionally favored banking stocks towards more defensive sectors, marking a significant change in investment strategy. For years, Singapore's financial stocks, making up nearly half of the Straits Times Index and driving the market surge in 2024, have dominated. But a different narrative is unfolding as the three major banks, DBS, OCBC, and United Overseas Bank, have underperformed the broader market this year due to growing concerns about slowing earnings growth and macroeconomic headwinds, evidenced by net institutional outflows of $259 million in just 2 weeks, contributing to a combined outflow of $2 billion this year, signaling a notable vote of no confidence from large investors. Consider this analogy. When a storm approaches, the preference isn't to be on a leaky boat, but rather on solid ground, which perfectly illustrates the current move by institutional investors towards the safer harbor of defensive stocks. So, which defensive sectors are attracting this smart money? Looking at the numbers, telecommunications has emerged as a leading defensive play in Singapore's market, with Singtel being a standout performer, having gained over 22% this year and recently nearing an 8-year high. An impressive feat during market uncertainty, further underscored by the substantial institutional inflow of $343.6 million in just 2 weeks, exceeding the $297 million received during the entire first quarter. The reasons for investors flocking to Singtel are twofold. Firstly, telecommunications is inherently considered a defensive sector during extreme volatility, as essential services like phone plans are typically maintained even during economic downturns. Secondly, Singtel is strategically positioned to capitalize on the expansion of 5G services in Singapore, projected to significantly boost revenue and innovation within the telecom industry, with Singapore's total mobile service revenue expected to reach $2 billion by the end of 2029, growing at a steady compound annual growth rate of 0.8% from 2024 to 2029, and notably, 5G subscriptions are anticipated to surpass 4G subscriptions this year in 2025 and are projected to constitute 90% of total mobile subscriptions by the end of 2029. A tree in Singtel, expected to maintain its market leadership, is well placed to leverage, highlighting the essential nature of telecommunications in our daily lives, almost akin to a utility. Further underscoring Singtel's growth prospects, the company has raised its guidance for FY25, forecasting EBIT growth in the high teens to low 20s, a positive revision from the previous outlook of low double-digit growth, with a projected dividend of approximately 16.5 cents per share for FY25. For investors seeking a blend of stability and growth potential, Singtel presents an appealing option, offering a competitive trailing dividend yield of 3.47%, coupled with promising growth prospects. Moving to industrial stocks, ST Engineering stands out as another significant defensive play with remarkable performance, having advanced an impressive 54% to record highs, leading the Straits Times Index in Q1 2025 with a 45.7% rally and reaching a share price of $6.79. making it one of the largest blue-chip gainers. This performance is driven by ST Engineering's robust return on equity of 26% and a substantial order book now at $28.5 billion, with $8.8 billion expected to be delivered in 25. Strong fundamentals that provide stability during market uncertainty, as industrial stocks like ST Engineering tend to benefit from long-term contracts and consistent government spending, offering relative insulation from short-term market volatility. However, the question remains whether this performance is sustainable or merely a temporary flight to safety. Analysts at RHB suggest this defensive shift is logical, recommending a pivot to defensive investments in Singapore given the increasing fragility of the trade-dependent economy amid U.S.-China tariff escalations, even cutting Singapore's 2025 GDP growth forecast to 2%, with downside risks leaning towards 0.5%. In this context, companies with stable earnings and strong dividend support, like ST Engineering, with its trailing dividend yield of 3.05%, become increasingly attractive, providing additional income support for investors. With the Singapore overnight rate average declining from 3% in January to around 2.5% by mid-April, and further U.S. rate cuts anticipated, REITs have emerged as another defensive avenue for investors. RHB has suggested considering real estate investment trusts for defense, highlighting industrial and office REITs such as CapitaLand, Ascendas REIT, Keppel REIT, and Fraser Centrepoint Trust as top picks due to their income stability and potential for upside. REITs offer several advantages during uncertain periods, including regular income through dividends, the backing of tangible assets, and often long-term leases ensuring stability. Furthermore, as interest rates fall, REITs typically become more appealing due to their yields appearing more competitive against bonds. It's worth noting, however, that REITs have experienced some of the most significant net institutional outflows in recent trading sessions, indicating that while they remain a defensive option, institutional investors might be exercising greater selectivity in their REIT investments, prompting the thought, in an uncertain world, wouldn't investments providing regular income while weathering the storm be preferable? Zooming out to the broader perspective, Singapore's benchmark index has demonstrated remarkable resilience in the face of ongoing tariff uncertainties, achieving a modest gain for the year and outperforming regional peers. The Straits Times Index has increased by 48 points, or 1.27%, since the start of 2025, even briefly surpassing 4,000 for the first time on March 28th, reaching an all-time high of 4,005.19 points. This resilience is attributed by Kenneth Tang, Senior Portfolio Manager at Nikko Asset Management, to Singapore's characteristics as a high-yield market, making it interesting and defensive in these times, due to its traditionally more defensive and yield-focused nature. The dividend yield of Singapore stocks stands at 4.93%, higher than that of Malaysian and Thai equities, attracting investors seeking income in an uncertain environment. Beyond high yields, Singapore's stable political environment, steady currency, and substantial fiscal reserves contribute to its ability to withstand trade headwinds, making its stocks an appealing choice for investors seeking stability during market turbulence, highlighting Singapore's unique position as both a financial hub and a high-yield market, creating opportunities potentially not found elsewhere in Asia. While the focus has been on sectors attracting institutional investment, some specific high-yield stocks may appeal to individual investors, with Comfort Delgro offering the highest yield at 5.16%, reporting a 15.4% rise in revenue to $4,048 billion for 2024 and announcing a total dividend of 0.0777 per share for the year. Keppel Corporation also presents an attractive yield of 4.96%, with a declared dividend of RM4 per share, translating to an annual dividend yield of 5.7%, above the Singaporean average. Among the banks, OCBC offers the highest yield at 4.95%, although, as discussed, banks have been underperforming due to earnings growth concerns. It's crucial to remember that while high yield is attractive, it shouldn't be the sole consideration. The sustainability of dividends and the company's growth prospects are equally important. For a balance of yield and growth, Companies like Singtel and ST Engineering might offer better long-term prospects despite the slightly lower current yields. If this analysis of Singapore's defensive stocks is proving insightful, please consider hitting the like button and subscribing for more updates on Asian markets. Your support is invaluable in creating more in-depth content. So, how should one position their portfolio given these market trends? A practical approach involves, first, diversifying across defensive sectors such as telecommunications, Singtel, industrials, ST Engineering, and selective REITs. Second, prioritizing dividend sustainability by focusing on companies with healthy payout ratios and strong cash flows over just high current yields. Third, balancing yield and growth, recognizing that the best defensive stocks offer both income and growth potential, as seen with Singtel's 5G plans and ST Engineering's robust order book. Fourth, monitoring institutional flows, as institutional investors often identify trends before they become widely apparent. And fifth, considering the macroeconomic environment, where with Singapore's reduced GDP growth forecast amid trade risks, a defensive stance appears prudent until great clarity on global trade emerges. Remember, defensive doesn't equate to boring or low return, as evidenced by Singtel's 22% and ST Engineering's 54% gains this year, demonstrating that defensive stocks can indeed deliver impressive returns during market uncertainty. The tariffs have redirected investor attention to Singaporean equities previously overlooked for limited growth, now recognized for their high capital returns and stability. As Kenneth Tang aptly noted, a lot more corporations are paying out even more yields or more dividends, and that is a perfect narrative at a time when there is a flight to safety and investors are focusing more on the certainty of income, highlighting how market challenges can unveil previously unnoticed opportunities. In conclusion, Singapore's market is experiencing a notable shift, with investors moving from traditional banking stocks to defensive sectors like telecommunications, industrials, and utilities. Singtel stands out with significant institutional investment and growth potential through 5G, while ST Engineering offers strong returns supported by a substantial order book. Singapore's overall market resilience, driven by high dividend yields, political stability, and strong fiscal reserves, makes its defensive stocks an attractive option for those seeking shelter from global trade tensions. What defensive stocks are you considering? And have you invested in any discussed today? Share your thoughts in the comments below. If this analysis was helpful, please like and subscribe for more insights on Asian markets and global investment trends. And for more on high-yield strategies, check out my video on top dividend ETFs for passive income in 2025, linked in the description. Until next time, this is Iggy from the Investing Iguana, guiding you through the financial jungle.